What if I told you that 84% of the S&P 500's gains over the last 60 years didn't come from stock prices soaring, but from something way simpler? Dividends. That's right. Those little cash payouts could be your ticket to infinite income. I'm George Mayfield, the Dividend Doctor, and today we're pitting the S&P 500 against SCHD, a dividend powerhouse, and I'll show you why chasing growth might be leaving money on the table. Stick around, because this could flip your investing game upside down. Today we're diving into a showdown, the S&P 500 versus SCHD, the Schwab U.S. Dividend Equity ETF. Spoiler alert, dividends might just steal the show. Let's break it down. First, let's talk history. Over the past 60 years, the S&P 500's total return, price growth plus dividends, has been massive. But here's the shocker. 84% of that return came from dividends, not just stocks going up. That's because companies like Procter & Gamble and ExxonMobil have been quietly paying shareholders for decades, padding returns even when markets wobble. Meanwhile, the flashy NASDAQ 100, it's all about growth, but growth without dividends can leave you high and dry when the party stops. Now fast forward to today. The S&P 500 and NASDAQ 100 are sitting at sky-high valuations. Price-to-earnings ratios are screaming overvaluation. Analysts are whispering that future returns could be subpar, think single digits, if this bubble pops. Why? Because when stocks get pricey, there's less room to grow. And here's the kicker. The S&P 500's dividend yield is a measly 1.3%. That's pocket change compared to what dividend-focused investments can deliver. Enter SCHD. This ETF tracks the Dow Jones U.S. Dividend 100 Index, 100 rock-solid companies with a knack for paying and growing dividends. Think names like Home Depot and Verizon. And what is SCHD's yield? Around 3.5%. Way juicier than the S&P 500. But it's not just about yield. Year-to-date in 2025, SCHD has outpaced the NASDAQ 100, proving dividend stocks can shine even in choppy markets. Why? Because when uncertainty hits, think recessions or rate hikes, dividend payers tend to hold up better. They're the tortoises in the race, slow, steady, and stacking wins. Let's get real with numbers. Say you invest $10,000 in the S&P 500 at 1.3%. That's $130 a year in dividends. With SCHD at 3.5%, you're pocketing $350, almost triple. Reinvest those dividends, and over decades, SCHD's compounding could blow the S&P 500 out of the water. 60 years of data shows dividend stocks often lead in total returns, especially when growth stocks stall. But it's not just about cash today. It's about resilience tomorrow. During economic downturns, dividend stocks have historically outperformed. They're like an anchor in a storm. The S&P 500 might soar in bull markets, but when bears growl, those low-yield tech giants can crash hard. SCHD? It's built to weather the chaos, making it a must-have for anyone serious about infinite income. Now, SCHD isn't perfect. It won't match the S&P 500's rocket rides during tech booms. Its focus is value, not hypergrowth. But with markets looking frothy in 2025, that trade-off might be your golden ticket. Diversify with SCHD, and you're not just chasing income, you're building a portfolio that laughs at uncertainty. With that said, it's time now for the Dividend Doctor's portfolio review. Our question today comes from William in Arizona, who asks, with the S&P 500 looking overvalued and SCHD delivering steady dividends, how do you weigh growth versus income in today's market? Well, William, with the S&P 500 looking overvalued, PE ratios pushing historic highs, and SCHD pumping out that sweet 3.5% yield, here's how I weigh growth versus income in today's market. Right now, growth stocks like those driving the S&P 500 are riding momentum, but that's a double-edged sword. Overvaluation means a correction could hit hard. Think single-digit returns or worse if sentiment flips. Chasing growth feels like gambling when the odds are stacked against you. Income, though? That's real cash in hand. CHD's dividend payers, steady eddies like Home Depot and Verizon, give you a buffer. They've historically outperformed during downturns, and that 3.5% yield compounds like crazy if you reinvest. So here's my take. In 2025, with uncertainty looming, rate hikes, inflation, whatever, I'm leaning 60-40 toward income. SCHD gets the nod for its resilience and cash flow, but I'd still sprinkle in some S&P 500 exposure for growth upside. Why? It's for portfolio balance. If the market keeps climbing, you don't miss out entirely. If it tanks, your dividends keep the lights on. Check out SCHD's holdings for quality, low payout ratios, strong earnings, and don't sleep on diversification. Growth's sexy, but income is sustainable. Just a quick note, folks, I'm not a financial advisor. This is all for entertainment and education. Investing has risks, and you could lose money. Do your own research and chat with a licensed financial advisor before investing. And that's it for today's showdown on the Infinite Income Channel. Dividends might just be the secret sauce to outsmarting the S&P 500, especially with SCHD in your corner. If you found value in this video, please smash that like button, subscribe, comment below, and ring the bell for more cash flow hacks. Drop a comment, S&P 500 or SCHD, what's your pick? Let's keep the income flowing. I'll see you next time, income chasers.